All right, so let's get into it, Andy. We're back. We're here, and honestly, let's just address the elephant in the room. What the Fed is going on?
What the Fed
What
the F is going on with the Fed?
With the Fed, literally.
What the Fed?
I feel like we've been waiting
Okay.
on their decision since the beginning of the year, since last year, and they've just been the ones that are kind of carrying the pace to see what's going to happen with rates.
Right. So they've said a couple things. So first of all, we have to establish that the Fed funds rate is for short-term lending. Just remember, short-term?
Sure.
Short-term lending. So things like car loans, credit cards, lines of credit, personal lines, that kind of stuff.
So not necessarily mortgage
Not
rates.
mortgages, no. But the Fed's sentiment about the health of the overall economy weighs in on how the mortgage-backed securities market puts money into mortgage-backed securities or takes money out of mortgage-backed securities,
Right.
or just prevents money. Like, I'm not going to participate. So the scarcity or the supply of the money allows rates to be high or low, depending on how much there is. So it's law of supply and demand. But,
Right.
So the Fed, they're in a very precarious situation right now. They're kind of in a corner because they're darned if they do, darned if they don't. So on one hand, their inflation is like out of control, right? Out of control is a relative term, but I mean, look, we haven't seen inflation like this in 40 years, okay? So I don't be hyperbolic and like, oh my gosh, the sky's falling. But here's the truth. It's bad.
Yeah.
It is bad.
There's no way around it.
Because you have multiple forces all converging at the same time. So this is one side of the coin. One side of the coin is the Fed is stuck because the inflation is bad and it's forcing their hand to do something about it.
Right.
But the one thing they have to do about it also brings pain. So if they do nothing, then inflation continues to run red hot. And then everything that we spend money on is going to continue to increase in price.
Right.
The only way that the Fed, with the levers of control they have, can try to tamp down inflation is by price control with rates, which means, well, if we make the cost of borrowing between banks higher, well, then maybe that'll slow down demand. Well, when you slow down demand, that's partially because of an affordability issue, which means that you're actually forcing the pain so that there's a slowdown of the inflation.
Right.
Which is also a bad scenario. So the other side of the coin is just as bad and maybe even worse as just letting inflation ride.
So it sounds to me that whatever way you flip the coin, we're on a course for a crash landing.
I don't think that's a fair statement to say it's a crash landing, because in my opinion, a crash would be like everything is bottoming out, everything is falling and broken. That's not really the case. It just is going to feel a little bit like that because it will be a hard landing.
Okay.
This whole idea of a soft landing is the same thing they tried to front run last year when they were saying, oh, everything's transitory. It's not transitory.
As we're seeing that now.
You don't create trillions of dollars of new money in circulation in a system and then call the consequence of that transitory. Now, the idea about that is that, oh, well, it'll eventually just work its way through the system and then we'll get back to normal.
Right.
Well, this goes back to you're darned if you do, darned if you don't. Back when the pandemic first kicked off and the Fed was like, we have to do something to try to keep and stabilize the market from completely having like capitulation and hitting the bottom.
Right.
Well, they made all the CARES Act and all these plans to keep money going and flowing. Well, this is the consequence of that. And if they would have done nothing, then the market would have had to figure itself out, and it would have been ugly back then too, because no one knew anything at the very beginning of the onset of this. Well, there's a lot more we know now, but now we have to deal with the consequence of the choice that was made at the time.
So it's June 14th right now as we're recording.
Yeah.
What has happened these past 2 days in the market?
It's been gnarly. The last CPI report that came out on Friday was 8.6%, which is the consumer price index. That's our consumer inflation. That is higher than the previous month's reading, which was 8.3. So they were expecting something to flat or even be a little bit lower. It wasn't either. It was higher. So that means that we are to expect that that's going to work its way through the economy for the upcoming months, which means the summer months, which is when people traditionally do more traveling, they spend, and a lot of people are buying homes during the summer because they're trying to get to the new neighborhood before the new school year starts and their kids have to start the new school or the new grade level they're going to.
Right.
So there's that issue. And the markets have reacted very negatively to that. And on Monday already, huge sell-off in the broad majority of the markets, and the bonds went crazy. The bond yield went higher, mortgage rates went higher, the dollar strength went higher, which is really all really just knee-jerk reaction in preparation for their announcement of their next rate hike. So the anticipated rate hike was 50 basis points, so 0.5%. Well, then people are saying, oh, it should be 75 basis points because we can really feel the pain. So 0.75. Now, there was even people over the weekend saying that we need a full 100 basis point hike on Wednesday. I think if they do that, it will shock the market into like some sense like, oh, wow, okay, so they are being serious about it.
Right.
But again, back to the two sides of the same coin, if they do 100 basis points, a full % rate hike, it's going to be instant.
Quickly.
instant pain now and for the next 6 or 9 months, because that decision today affects lending for all the new originations of car loans and credit cards and lines of credit.
So
and all that's going to come under duress.
I'll bring it back to the mortgage industry. So basically what I saw down on the, on the rates when I was pricing this past 2 days, let's just say we went from being able to do 5.5 to now 6.5.
Yeah.
Right. So
Yeah.
it's just so you get an idea, depending on where your credit is at, you could see a loss of a percentage in your rate, or, 0.75%. But the drastic, change did happen these past couple of days.
Yeah.
And tomorrow the Fed goes back up to bat, and, we're going to see basically what direction this market's going to continue to move. I know we don't have a crystal ball, but what is your expectations, or what do you foresee happening tomorrow?
I think they would be wrong to just do 50 basis points. So as much as it pains me to say that and know what the consequence of that choice is, I think it'd be wrong for them to stay to 50 basis points. That was from their Fed meeting minutes that came out 2 weeks ago. They said that we're going to do a 50 basis point hike in June, another 50 basis point hike in July, and they figure, that's going to be enough. I think it'd be wrong for them to do at this point. I think the reading of 8.6% CPI was way above what they expected, and I think now they really actually have to put their foot down, and it's going to cause some pain. So I think they have to do 75 basis points. If they do 100, I honestly think that would be a firm reaction.
Right.
And it might be a little bit too much too soon. As much as I've already railed against the decision being causing these consequences, going from 50 basis points from your meeting and just a couple weeks later saying, we got to double that. People
are going to feel it.
That's a stark move.
Definitely. So moving forward, earlier you mentioned something about consumer credit scores going down as an average.
Right.
Could we foresee that happening because of rising debt?
So what I was referencing is a report that came out about the average consumer credit score that has applied for cash out refinances in the last 60 days has been lower than the credit scores of those who did cash out refinances at the beginning of the year.
Oh, okay.
So it's down by 7 points by average. What that means is that of the mortgage applications that have originated and closed in the last 60 days for cash out refinances, the average credit score of that borrower has been lower. I think that's the canary in the coal mine. I think that's like casting a little bit of a warning, like, hey, people who have lower credit than those who have already done this are now coming into the fold and raising their hand and going, hey, I need to do something. I need to do something about my situation. We're not going to get out of this inflation pain in 30 or 60 days.
Yeah.
This is going to be likely a couple of years, honestly, just from our previous experience of going through the last round of the market having this kind of reaction to things. It's going to take a long time. And so I think people need to be looking at 2 to 3 year options right now as far as what does my life need to look like financially in 2023, 2024, and then I can take a new look in 2025. And I think that's where maybe some people who have maybe less than 720 but still above 640 credit. So 640 to 720 credit.
Right.
So they're not in the 800s, but they're in that like next $60 or
that
60
strong
point bucket.
like threshold. Yeah.
I think they have to really take a serious consideration of what the next 2 to 3 years looks like. There's no indication that rates are going to they're going to go down. I think they're going to level off in the summer because they have to.
Yeah.
Otherwise, demand will completely dry up, and that will cause other ripple effects to the economy.
Makes sense.
Especially real estate.
Yeah.
But particularly the cash out can help because the cumulative out-of-pocket expenses someone's paying with their mortgage plus all their debts. If they cash out and pay off those debts and they have a higher mortgage payment, that could still be less by hundreds of dollars. It could be way less than paying all the out-of-pocket stuff still on its own.
I actually have a case study that I just, happened to help a family yesterday. We just closed on the cash out refinance, right? And they were going through the exact same problem, right? They had thousands of hundreds of thousands of dollars worth of debt. They were default on some of them, and a lot of it was weighing their credit down, right? I started working with them in January. They were way below the minimum score to get a FHA cash out loan. We then, analyzed their credit, looked through it, told them what they needed to do in order to get it up above the minimum credit. And we did it, right? And right after that, we're able to get their file into underwriting and begin, working on the cash out, refinance it. So fast forward to yesterday, funding it, they were able to wipe off over $120 in $120K in debt.
120,000?
120,000. Cars that they didn't pay, credit cards that they couldn't pay anymore that just defaulted.
Oh, wow.
And on top of that, they took some extra cash out to hold on to that because I told them, hey, these next couple of months are going to be even tougher, right?
Yeah.
Now that you already went in there and did the damage, might as well just, take as much as you can, can you still make the payment? Yeah, the payment's still, good. They were just drowning in monthly payments for the credit cards, right?
Yeah.
So now we removed about $2,300 worth of debt that they needed to pay a month.
Monthly? Out of pocket.
Out of pocket.
Dang, that's
out
a
of
lot.
pocket.
That's a lot.
Yeah. So then their mortgage payment did go up significantly, like by $900. But it's still, I mean, if you do the math, $2,300 by $900, you're still
they're net positive still.
Exactly.
Which is the point, is that they're saving money every month because they're not paying on those things they've closed and paid off.
Right.
Yeah.
And then I told it, this is just a temporary Band-Aid, right?
Yeah.
What goes up must come down, as we saw 2-3 years.
Yeah.
Like you said, 2025, let's regroup, let's reopen this case, and then bring you down to a conventional, refinance you out of that PMI, and then now you're saving $400 extra.
Sure.
So it's stuff like that it's very important, especially right now that people have that option, because in the next 6 to 12 months, they probably won't have that same, opportunity to be able to tap into that equity.
Well, I think we're talking about something that's super, super unpopular in our industry right now.
Yeah,
People don't want to deliver difficult news, even if it's honest.
Of course.
And so I think what's happening right now is that we're having a real conversation about what's happening with people that are coming and talking to us. And I've noticed that in times like these, people are typically a little bit shy to come and say something because they might be embarrassed or they're ashamed of their situation.
Definitely.
But we have been there before. We've already been through this in 2008 and 9 and 10. Here's the difference. Back in 2008 and 9, when the mortgage meltdown happened, everyone was max leveraged on their loan compared to the house value. That's not the case now. We're seeing people with 30, 40% equity in their house. And before there is any sort of correction in house prices, the equity is available now. That's why I keep saying it's like a 2 to 3 year solution.
Yes.
So people are like, oh, well, that you're crying wolf and the sky's falling. No, I'm saying like the writing is on the wall.
You're just being proactive.
When there's a slowdown of borrowers buying houses at all-time highs, the only way for sellers to sell is to make a more attractive price. When the cost of borrowing money goes up, the amount they can afford has to come down. So even if it's a 5, 10, or 15% correction in the market, that's equity getting squeezed out of someone's position they have today. So even if the rate seems unfavorable today, but the equity is good, look at how you can like mathematically advance your position. That's
what I've been telling clients: price over percentage, meaning, or payment over percentage. Make sure that you can afford the payment because the percentage could always switch, So
well, but people think that's a tricky way because people think that's a tricky way because he can't sell the rate, your rate's high. That's not the thing here.
I mean, it's the way that I say it is that like, hey, the rate's going to be going up regardless, right? But the monthly payment you can afford if it's, easily be able to be paid. Your rate could come down in the next, 6, 12 months, maybe even 2 years.
My point is that's not tricky sales language.
No.
My point is I'm trying to make it, that's not tricky sales language. People try to say that that's tricky sales language because, you don't have a better rate, so you got to try to convince me to a higher one.
I mean, we all drink from the same fountain, so...
Yeah, that's what I'm saying. It's unilaterally across the board. Everyone's rates are changing at every bank and every institution. But what I care about the most is how do we solve people's problems they're having? What I see, and again, from the very beginning, when we started this company, 16 years ago, is people need help and they don't get help unless they step forward and say it. I don't know that you need help.
Exactly.
I don't get your credit card bills. I don't get your car bills. I don't know if you're late. I don't know any of that stuff.
And I feel
but when people can tell us that, then we go, well, let's try to fix it somehow.
And it's not so much of like, hey, I want to like get your loan. It's like literally if you need help and you don't know where else to go, like there's only 1 or 2 options. You're going to like keep building up that debt.
Look, I told this guy no. And he'd already gone to talk to 3 other people. And he's like, oh, this guy said this guy said that. But like, what would you suggest? I said, you don't need to do this right now.
Yeah.
He's like, what are you talking about? I said, you're asking for $150,000. You don't need it. You said you could do this or do that. That's not going to save you enough right now. So if you're going to come back in 6 months or 9 months and be in the same situation, this doesn't help you now. So I don't want to do this.
Right.
And he was like, what?
Well, it's like you're just being honest.
I didn't take a sale.
Yeah,
exactly. And he was in sales. He was in insurance sales. So he's like, this guy should be trying to sell me. But I was like, no, that doesn't solve the problem you came here telling me you had.
And that's one of the biggest differences that I do see. And I don't like to say like, hey, we're the best. We do everything like, better. But we actually take the time to understand the people's situation. And then from there, create a plan based on, what they need. Not like, this is what I feel that's going to be the solution for them. But it has nothing to do with their goals and what they want to actually accomplish.
And I think part of that and part and parcel of that is asking the questions, okay, well, if this solution we're talking about right now isn't the right solution for you, what's plan B? Because if there isn't a plan B, then what you came in here with is going to continue remaining a part of your life until you course correct that.
Yes.
So if you're saying you're drowning in debt, your monthly payments are $2,300 more than they could be, then like you're in a tough spot right now because everything else is also expensive. Gas is more expensive, food is more expensive, even just services are more expensive. for non-product services.
Well, I went to a restaurant the other day and there was an inflation fee.
Yeah, you got an inflation fee on the receipt.
Like,
that was crazy. You texted me
and
that.
then
I was like,
I'm
that's
already
crazy.
like, wait, isn't it already priced into the higher price of goods? And apparently it wasn't.
No, and you know why? Because that's a reflection of price changing so rapidly.
That's exactly where I was going to go with. They can't keep up and price everything literally every other day.
Remember when gas stations used to actually have numbers,
the meters
on the sign? No, like numbers on the sign.
Oh, okay.
On the sign on the corner.
Yeah. Now they can't change it fast enough.
yeah. There's like a guy at a keyboard like changing it every 30 seconds. Like, oh,
God dang it!
619, 629, 639, 649.
650.
Yeah, just by my house, between the span of 7 days, it went from on one Saturday it was 619, and then on the following Saturday it was 645.
It looks like mortgage rates are kind of catching up to gas prices.
Yeah, I don't know if they're. I'm not gonna sit here and tell you they're directly correlated. They're not, because everything that's going up is going up together.
Yeah.
Here's an interesting factoid I was talking to someone the other day about. I was like, the reason that inflation was only 8.6, even though it was higher, is because lumber tanked. Because lumber's mixed into that, and because demand for building supply is so low, lumber dropped like 28%. So think about that. There's some things going up by 30, 40% in cost, and lumber went down 28%.
Where do we short lumber?
So moves like that, where certain things are really volatile in price up and really volatile in price down because of lack of demand, is generating that 8.6 print. I mean, can you imagine if like lumber was still where it was like 6 months ago, 12 months ago?
Number.
We'd be at 12, 13, 14%. Now, and it's not just that, but the definition of how inflation is calculated has changed, because there's the core CPI and there's the CPI, and they strip out food and energy because they're too volatile. But you know what I've noticed about volatility? I still pay for food and energy
all the time.
So
every day.
You can tell me you should take it out of your equation,
but I'm still paying for it.
Yeah. So when you pack that back in, we're really more like at 16, 17% inflation.
And
there's the news.
That's what the headlines don't want you to know.
No, they don't want to tell you that.
No, of course not.
But that's what people need to know.
Yeah, exactly.
So I'm fine saying it.
Yeah.
If the stations don't want to say it, I'll say it.
Well, it was just like we were speaking.
I look at it all the time.
Yeah, we were speaking earlier. Like, it sucks, but the consumers are going to get, the news a week, 2 weeks later, and by that time, something else is already happening, or we're in a complete different situation.
Or it's just driven so far down in the news cycle that it's not deemed important. Like, what are the main 3 things that happened today? And it's never rises head above 10.
Johnny Depp,
yeah,
you know what I mean. But okay, so segueing into our last topic for the day, home prices.
Yeah,
where do we foresee them going? With everything happening in the economy, with the demand, still being there, rates going up. What can we say home prices will be these next coming 6 to 12 months?
So I think for sure, I feel super confident saying home prices are going to stall. I think they're going to get stuck.
So you said stall, not drop.
Stall. I think they're going to stall first.
Okay.
And then I think people who have a cause to sell, like I'm retiring, I'm moving out of the state, I need to downsize my life, things like that, they're going to have to sell for other reasons other than getting top dollar.
Right.
So if that's the case and more inventory comes up in the summer because these people who didn't sell over here 6 months ago are going, oh my gosh, I missed the boat, and are trying to get on the boat now. Those late to the market sellers are going to have to jockey for position on price with each other. And I think that's when you're going to start to see some price competition to the downside.
Because that's what I was saying. I was listening to a podcast this morning, Frank and Gary, but I think it's just Frank now.
Yeah.
But he was saying that, as the prices go up, they're going to have to at one point be able to stall them and stabilize them because of the demand not being there as as high as it should be, right?
Right.
So what's going to happen with people that are, like you said, oh, I missed the bus from 6 years ago. Now I want to come and sell it for top dollar, but the top dollar market isn't there anymore.
Yeah, well, again, this is where I'm saying it comes. It's just like the cash out talk we just had. It's circumstantial, because there's some sellers that have to move because they're retiring and they already have a house they bought somewhere else, so they're leaving this place. They don't want to have a rental.
Right.
They're leaving it. They want the cash out of it. Well, if selling it today and taking a haircut of $25,000 is better for me than selling it in 6 months and still getting a $25 haircut, I'll just take my money today.
Right.
And then you have people that PCS into San Diego and out of San Diego for their military service. And then you have people who have change of job.
Right.
Then you have people whose marriages are ending. So there's circumstances.
Life's still happening.
There's circumstances that are going to generate some of this, where the market or the decision doesn't care what the market's doing.
Right.
If a judge hands down a decision that the house needs to be sold to separate the assets between these two people, they're not looking at the market for when that should be. It's like, sell the house.
I just want whatever half of it is.
Put the house on the market and sell it. We have to divide the assets, sell the house.
Right,
So
right.
they're not waiting for, well, let's go look at the chart and see when the economic top is going to be. Like, that's not the case.
No, not at
And
all.
and on the buyer side of this, buyers are being a little bit more, they're being more discerning, and they're being a little bit more scrupulous in what they're gonna put money for, because now they're looking at, okay, hold on, if I make this purchase today, I know I'm gonna have to refinance later, so I'm not gonna even just be in this loan forever. So I gotta get this one I gotta get to get in the house. Then I'm gonna have to refinance this later, and then I'm probably gonna end up being in this house a lot longer than I was expecting to be. So that is something I think they're considering, and then they're also going to say, well, I'm not willing to pay that much anymore. So when a person's willingness stops showing up, that then makes sellers have to entice them. And I think when the table turns and tilts that way, that's when you start seeing the flattening turning into a correction.
And that's how I felt like everybody was enticed when rates were so low these past couple of years, where it's like, oh, rates so low, like I could afford this, I could afford that. But rates kept going up, and they're like, I could afford less, I could afford less, I could afford less, to the point where now it's like, dude, I can't even afford.
Yeah, I mean, well, for some people that were already on the cusp of not being able to afford getting in the market, they're out of the market. For the people who can afford the upswing of a 0.25%, 0.5% rate hike right now, they're going to be just fine, as long as sellers also acquiesce. Sellers are going to have to determine, you know what, I can't sell for 900. I'm going to have to sell for 875 or 850. And then when they do that, then you're going to find a meeting of the minds in the middle somewhere.
And it's funny because I've been seeing a lot of listings go out without an offer when they get up on the MLS for the first weekend, right?
Yep.
And the open house.
Yeah.
And I've been noticing that the offers don't start coming until a little bit after the open house, maybe 2-3 days, because we call the agents and we're like, hey, like, how are you guys looking at offers? Look, honestly, we don't even have any. So it's kind of like we're starting to see that people are slowing down on the offers. There's not that much, bidding war. So a lot of the sellers are being a little bit more reasonable. And we're starting to notice that switch or that stabilization in the prices as far as, them being how they were literally 3-4 months ago.
I think when we look at the house price index in July, August, September, it's going to look a lot different. Because right now in, like, let's say May, June, we're seeing the impact of decisions that were made back in February and January. So those choices over here are now impacting the May and June information.
Right.
The decisions of May and June, we're going to see that in July, August, September. It's going to be a lot different than the beginning of the year.
So we can confidently say that moving forward, the housing price might stabilize. We're looking at it not to drop, but just stabilize in the months to come as everything kind of crashes over and we see what the economic forecast will be.
In general, yes, but I'm gonna default back to that age-old adage: is price is what someone's willing to pay for.
Yeah,
that's it. The price, the value is what someone's willing to pay. So if the house is not getting the price that the seller wants,
right, it's going to come
it'll
down
go
to
for
what
the
the
price
buyer.
that the buyer wants. And
Here
the
we
seller
go again.
accepts.
Switchity switch.
Yeah. Yep.
Well, I think that kind of covers everything that we had to speak about today. Thank you so much, and we'll be back next week with some more topics for you guys.
All right. See you guys.
Thank you.